had the opportunity to take over as the chief investment manager for what's called a family office, which is a group of high net worth families where Jeff managed the investment assets inside of that portfolio. He brings a wealth of experience and professionalism. And I think you're going to see tonight why I was so excited and why he's been such an addition and such an asset to Nowlin and Associates. So, Jeff, I want to turn it over to you to talk a little bit about your experience in the industry and where these ideas and these concepts came from.
Sure. Thank you very much, Justin, and thank you everyone for taking the time out of your schedules during these crazy times that we're dealing with. And as Justin said, I kind of started my career down in South Florida at a major Wall Street investment firm. And when we came into the office every day, this was in the early 90s. We would all sit down at our desk. We would hover around, and there was this little box on our desk called a squawk box. And if any of you watch CNBC in the mornings, that's the name of the show on CNBC before the market opens. And what this little box would do, we'd turn it on, it just gave this terrible screeching, squawking noise, how it got its name. And the analyst from this investment firm, all the analysts would come on the speaker. It was tagged into their morning meeting, and they were giving us recommendations on what to call our clients and do every morning. They would tell us to call your clients and have them buy ABC. Call your clients and have them sell XYZ. So first year in my business, I did what I was supposed to and did exactly what these so-called experts were telling me to do. But I was extremely lucky to land this client down in South Florida. But some of the first instructions he ever gave me was, Jeff, please do not call me with your analyst recommendations. I want to make my own picks. And again, everybody, this was before the days of Charles Schwab and E-Trade, where somebody that wanted to do their own portfolio management, it was before they could get on this new thing called the internet and do it themselves. Everybody kind of had to have an account with an investment firm. So after about a year of following my analyst recommendations and getting hurt many times where it was almost, it was extremely hard to pick up the phone and confront these people, these clients that had entrusted me with their money. But I started looking at what this one particular client was doing in his account compared to everything that I was telling my clients to do. A lot of times he was doing the exact opposite of what my analysts were telling me to. And one day, I got up the courage to give him a call and asked him, what are you doing that's so different? Especially on the downside during, down times, you're, before things kind of get really bad, you're selling. And he said, Jeff, you're a real go-getter. You follow my instructions, and I would like to introduce you to a family friend who taught me everything that I know. And it's a strategy that this individual was using to manage his own account. But he said, there's one caveat. I know you're an Alabama boy, a country boy, but you're going to have to get on a plane and go to New York City. So, what we did is, this country boy, got on the plane, New York City, just like he asked. And, I thought, I was going to get to go into, the Trump Tower or the Twin Towers or the Empire State Building, all these fancy buildings, but it was really the exact opposite. When we landed at LaGuardia, we got in a taxi cab and went through the upper boroughs of New York through the Bronx, which doesn't really look like that's where investments are run. Went to an industrial part of New York called New Rochelle. And we pulled up to this building that was very industrial looking, almost like a place where somebody sell shoes or repair shoes. And on that door was a name of a company. It was Chartcraft and Investors Intelligence. And we went in, and I was introduced by a gentleman who ended up being just a wonderful mentor and totally changed my career in the way that I still look today on managing money. His name was Michael Burke. He was on CNBC probably once a week in the early 90s. And this guy did not look the role of a Wall Street investment guy. He had white hair standing up on top of his head. He looked just like Albert Einstein. Never had his, had his tie, halfway up, to his collar. And if I would have given him an IQ test, it probably would not have surprised me if he was right up there with Albert Einstein. And what this gentleman taught me, the primary thing, is that there's two different ways to analyze companies, stocks, and the markets. The first one, almost everybody's familiar with, and that is fundamental analysis. Fundamental analysis is looking at how much a company is actually earning. Because, even though it's a stock in a company, it's no different than a candy store down the street. You want to look to see how much money that company is earning. You want to see the revenues of the company. Revenues is, that's very important. The sales coming in. You want to see the management contracts, their factories, how productive they are. All of that is extremely important. But he taught me that's not the only way to analyze stocks, Jeff. The other way is technical analysis. And technical analysis is really the study of the supply and demand of the actual securities themselves, which is very, very important. And you can use that to determine when to buy and sell these fundamentally good stocks. And he didn't invent this process. It goes back where he learned it from an individual that worked at Chartcraft and Investors Intelligence by the name of A.W. Cohen. A.W. Cohen, there's not a lot of information out there on the internet on him or anything. He was, before CNBC, but he did a lot of study on this point and figure analysis, which is the type of technical analysis that Michael Burke taught me and that Michael Burke used. And A.W. Cohen did a lot of studying, and he wrote many books on it in the 1940s and the 1950s on this particular form of technical analysis. But A.W. Cohen didn't invent this form of very simplified technical analysis either. It kind of went down through, I want to say, the generations, and it goes back all the way to the late 1800s. I want to say invented by an individual by the name of Charles Dow. And that name, for some of you, may be very familiar, especially that last name, because Charles Dow formed in the late 1800s the Dow Jones Industrial Average. He was the founder of the Wall Street Journal and eventually sold the Wall Street Journal off to an individual by the last name of Barron, which was Barron's Magazine run out of Boston. Some of you have heard the Dow theory, which Warren Buffett, was a big student of. He's the one that kind of came up with the Dow theory. And he was just an unbelievable smart man way before his time in the late 1800s, really a studying and a doctor of the actual markets. What Charles Dow started doing is every evening after the close of the market, he would start to study the price movements of actual securities themselves. And what he started to do, he would take a piece of graph paper, and every time a stock would go up by a point, he would fill that chart paper in with a column of X's. And what he did when the stock started going down, he would plot a column of O's every time that stock started to go down, and back and forth. Stock went up, he plot X's and O's and X's and O's. And this is how, when Michael Burke taught me, it was before this type of analysis got put on the internet and you could do it by computers. So every evening back in the early 1990s, I would go home and I'd spread out the graph paper, and I had tables full of, pieces of paper, and I'd sit there and do my X's and O's on this paper at night. So, what Charles Dow found in studying these X's and O's is that patterns were being developed. And some patterns, like, some examples on the left column, were very bullish. In other words, these particular patterns, he found that the chances of success of these stocks going up was very, very high. But yet he also noticed, and also further studies by A.W. Cohen and Michael Burke and myself, is that some of these patterns, like the ones on the right side of the column, the chances of those stocks going down were extremely high. And if you look on the bottom left-hand corner on the bullish side, this is probably the most important pattern that was being developed, and it was called a trend line. And what would happen when a stock, if you notice, would get down towards that trend line, it would act as a floor. You know, the stock would come down, it would hit that floor, and it would bounce off. The stock would hit that floor, and it would bounce off, just like a floor that's going at a slope. But yet on the right side, on the bottom right corner under the bearish, that's once an uptrend line has been broken, and now you're in a downtrend line. So what happens at that point is the stock comes up, and that trend line becomes now a ceiling. So what Charles Dow started trading on with this, and A.W. Cohen and many famous investors and very successful investors throughout time, is they would be in a stock that was in this uptrend, and as soon as that stock would break that trend line, they would sell the stock, or some people call it they would use a stop loss order. That's where they would get out of the stock if it broke that trend line, because then the chances of the stock going down is very, very high. Let me give you an example of what can happen when a stock breaks its trend line. Very, very famous stock in our markets. One of the main reasons is because all the way down to the company going totally belly up, Enron was being touted by CNBC. They were jumping up and down. This company can never go out of business. You know, it's cheaper than it was last week. It's cheaper than it was the week before that. All the analyst experts that I used to listen to were all jumping up and down saying, you need to own this stock in your portfolio. But if you notice, you know, if you can see my mouse, that stock broke that trend line, and the stock just continued. You know, the X's and O's, it broke that trend line, and the stock just continued down. It doesn't happen every time it breaks that trend line, but you don't want to get caught in a stock that's doing this. You know, I could take so many different stocks in the 07 through the 09 Great Recession that Justin referred to. I can put on Washington Mutual Bank, you know, a bank that was, you know, very prevalent here in Alabama, Colonial Bank. Okay, Lehman Brothers. Lehman Brothers survived the Civil War. They survived World War I, World War II, the Cold War, the Great Depression, all of these things. But I could overlay their chart with this Enron, and you would have never been in any of these stocks that I've mentioned if you would have followed this trend line theory and stopped out at a, you know, you may have got stopped out at a gain or a small loss, but you should not have been in these types of securities when it breaks a trend line like this. So, excuse me, when I start building the portfolios for our clients, the first thing that I look at is the overall market themselves. Jeff Allen and the money that I'm managing for our clients, we're not moving the markets. Mr. Smith down the street that logs into his E-Trade every day and does a couple of trades, he's not moving the markets every day. It's the big hedge funds that you always hear about, the pension funds, the big mutual fund companies. If they have their finger on the buy button, there's more than likely that particular stock in the market is going to go up. It's just very simple. Economics 101, supply and demand, the first thing that they teach you in economics. But on the other hand, if those institutions, or Warren Buffett of Berkshire, which we just heard about this past weekend in February, started selling all of his airline stocks. You know, if Warren Buffett and Berkshire is sitting there and they're aggressively selling, where they don't really care about the price that they get, and they're just hitting that sell button as fast as they can, guess what? Supply and demand on those actual securities and those airline stocks, like they did, are probably going to go down. So with the market, the first thing that I look at in building the portfolios is, are we in a green light? And what that means is, are the institutions out there actively buying and supporting the market and supporting their stocks? If I'm starting to see some institutional selling coming into the market, I may go to what I call a flashing yellow light. And that just means I may wait a little bit longer for the stocks to come down closer to that floor, closer to that trend line before I buy them. Or let's say right now we're in the middle of earnings season. Last week in individual names, you saw a lot of volatility around those earnings times. So during a flashing yellow light, what I may do is like, you know what, that stock looks really good. It meets a lot of my criteria, but because we're starting to see some institutional selling, I may wait until after they come out with that earnings report. I may miss some upside, but again, the primary thing I'm trying to do is protect my clients' money on the downside. And then, just like we started seeing at the end of February, first part of March, we saw, I mean, it wasn't a flashing red light, it was a strobe light of red coming to the market where, you know, institutions were actively selling. And now that the reports are coming out of the first quarter of institutional buying and selling, just like Warren Buffett did this past weekend, it's very, very obvious that it was the institutions out there actively selling when this COVID-19 got out there. So what I do on a red light, I sit on my hands. No matter how good or cheap I think a stock is looking during a downturn, during this red light, I sit on my hands and do absolutely nothing. What I do is I just start putting together a buy list. So once those institutions come in and start buying again, like they did the first part of April, and it goes to a green light, then I have my shopping list ready and ready to go back into the market and, you know, basically ride the coattails of these institutions. Go through here. So again, the fundamentals, going back to the fundamentals, it's extremely important. So what I start doing is a filter of all of the stocks. There's right at 6,500 stocks that are traded on the American exchanges between the New York Stock Exchange, the NASDAQ, and the American Stock Exchange. There's roughly 6,500 securities. So I'll start running filters on all of those companies. I'll start, okay, give me the strongest earnings per share growth. Give me the companies with the strongest revenue growth. I don't want to see those earnings per share elevated because a company is trying to cut cost. I don't want to see earnings per share because they're laying off employees, because they're closing down factories, because they're selling off assets to what I call, you know, almost an artificial earnings per share boost. I want those earnings per share to come from because Apple's selling more iPhones, or Microsoft is selling more of their software and more of their cloud space. I think it's very, very important to have healthy earnings per share, not unhealthy earnings per share. I'll throw in return on equity and all of these different things, which, boom, down at the bottom, you know, during good times, it filters out from 6,500 securities to about 250 securities that now I will take a look at. So now if we start building the portfolios, all of these different factors have to come together. We have to have the economics right. We have to have the market in a green light. We have to have the fundamentals right. And we have to have the technicals right to, boom, there's a stock that we will buy. So if any of those factors are missing, that particular security does not get added to the portfolio. We will go to something else, and we will wait until all of those factors come out together.
Hey, Jeff, could I say something real fast?
Yeah, please do.
So this was something I wanted everybody on the call to recognize. So when we're talking about safety of your money, a big point that Jeff made that everyone here at Allen and Associates really strongly believes in, again, is think about how the protection and the risk standpoint. So not only do you have a screen of fundamentals, meaning is it a good company, is it growing earnings, but then the next level, you have a technical screen where it begins to screen through what kind of momentum is in the market. Are the institutions buying or are they selling? Then you go to a third screen, which is an economic screen. Where are we in the economy? Where are we in the market? And so you're talking about levels where most money managers you look at are fundamental managers and fundamental only. Then you'll have some managers that are technical only. And then you'll have some economists that follow the economy and are looking at just different sectors based on how the economy is doing. So we're bringing together what through Jeff's strategy and what he's been taught and handed down generation to generation to generation is bringing all of that together, all of that under one roof. And that goes to give you layer upon layer of protection. And then we're going to move even further into that. And that's something that's coming. But I wanted to make that really clear because that's one of the biggest things that really impacted me and some of our team the first time we had a chance to interview Jeff. Go ahead, buddy.
And something on top of that, Justin, where, some portfolio managers or mutual fund managers are, fundamental and some are technical, but what most all of them are is they are very, very close to 100% invested 100% of the time, where, it's okay at times to sit back and have a large cash position just so you can sleep at night. The portfolios that I manage were in cash almost all of 2008 and the first half of 2009. And you know what? That's okay. Again, it goes back to what you kind of started the call off with, and that's win by not losing. We're not going to try to pick the bottom of the market. We're not going to try to pick the top, but we're going to try to do as well as we can in the middle. The first portfolio that I manage is a growth portfolio. And those filters that are going through there, it's it has high expectations of these companies. I want to see, during most times, 20% or more in earnings per share growth year over year. I want to see 20% or more revenue growth year over year. I want to see return on equity and margins are 17% or more, and all of these factors. And it's not easy finding companies that can do this, especially, large companies. And, some of them have been able to, like Apple, like Microsoft, like Facebook. They're the type of companies that are changing the way consumers are doing business, changing the way that businesses are doing business. They're really, Facebook changed the way that grandparents look at their pictures of their grandkids. Apple changed the way we use a phone. Who would have ever thought, just, a generation ago, what we could do on the phones that we're doing today. Apple's a type of company that changed that. Netflix totally changed the way that we watch movies. So those are the type of companies, if everything works, looks at it fundamentally good and technically good, that we're looking for in the actual, in the growth portfolio. The equity income portfolio is similar in the technical aspect, which I'll go deeper into, but on the fundamental side, where the difference is I don't have such high standards in the earnings per share and revenue growth, because these are usually going to be your larger, more mature companies. But I still want them to have positive earnings per share growth, positive revenue growth, and something very important is a high dividend yield. This portfolio is going to be less volatile than the growth portfolio, again, because it's more your larger, more mature companies, and that dividend also helps protect that price from the volatility. I usually use the 10-year Treasury yield as a benchmark for a dividend yield for these companies to make this basket of stocks that I'll consider. But the 10-year Treasury yield's all the way down to, it got down to 0.5%. I think right now it's somewhere 70, 75 basis points. So right now what I'm using as a filter for the dividend yield for this portfolio, usually somewhere in the 2.5 to 3% on a minimum for the dividend yield to make the cut. But it can't be just a one-time, thank you dividend. I want to see companies that have consistently, year over year over year, raised that dividend. It's something that I've learned that the strongest dividend is usually the one that's just been raised. About 2.5 years ago, everybody wanted to ask me about GE, because because of the price drop, now had a 7% dividend yield. I'm like, no way, the technicals don't look right. And guess what? They were cutting that dividend all the way down to basically zero. So the dividend yield is important, but really the most important thing with that dividend yield is that they've been consistently raising that dividend. Sometimes stocks in this portfolio have raised their dividend for 20 years or more every single year. And that's the type of stock that we're looking for in that portfolio. A couple of things here. Well, let's back up. I don't want to go that far. Where's my back button? We'll leave it on there. Getting into the technical analysis and building the portfolio. Once, I've kind of filtered all these stocks through, I want to buy a stock that is, if you remember, has come down to that floor. I want a stock that has come to within 8% of that trend line. Because what I'm going to do, if that stock breaks that trend line, Jeff is going to close his eyes. He's not going to worry about Jim Cramer's jumping up and down about the stock. I'm going to sell that stock. I'm going to take a maximum of 8% loss in any one stock in my portfolio. Now, what that allows me to do, because I'm looking for at least 25% on the upside, it allows me to be wrong 3 times for every 1 time that I'm right and still make a little bit of money in the portfolio. Hopefully during good times, the numbers are a whole lot better than that. But what we've done is we've got the math in our favor. And so many investors, whether it's the individual investor, whether it's a portfolio manager, whether it's a pension fund, they fall in love with a stock. They'll put, say, $10,000 into a stock, and that stock goes down and down. And they're like, okay, if it was cheap, if it was cheap at 100, it's even cheaper at 70. They'll let it go all the way down to, say, $50 a share if they bought it at 100. They will finally give up. They'll sell the stock. Well, now their $10,000 is worth $5,000, a 50% loss in their original investment. But they really have the math going against them, because the next stock or an investment that they buy, it doesn't have to go up by 50% to get back to even. It has to go up 100% to get back to even. Being in this business for almost 30 years and managing money, it's not easy finding something that you can make your money back in, at 100%. Whereas if I take a loss at 8%, the next investment that I put into the portfolio only has to go up by 8.7% to get that back to even. And these portfolios, I do believe in diversification, but we usually take a 12% position in any one stock in the portfolio. And if I limit that loss on that stock to 8%, that stock, if it's stopped out, is only going to affect the overall return of the portfolio by less than 1%. And that's how, again, we're managing the risk on the portfolios.
Hey, Jeff.
So
say that one more time. I think that is such a key point. Okay. So if the portfolio, whether growth or equity income, if it's fully invested, so you take a position of 12% per stock, you put the stop loss at 8%. So talk through again how that impacts the overall portfolio, because I think that is such a key point. Sure.
So, and again, if you can envision the trend line, which we'll show you some examples again here in a minute, if it comes down and hits that floor, that's kind of where we want to buy it. But if it breaks below that floor, we're going to stop out of the stock. Stop, a stop meaning we're going to automatically sell out of that position. So if I have a 12% position and I take an 8% loss, it affects the overall return of the portfolio by less than 1%.
Wow.
Yeah, and again, envision the trend line, which goes at an angle like this. So as the stock's going back and forth, that trend line continues to go up. So as that stock goes back and forth at an upward trend, it allows me to continue to raise that stop loss point as it goes. So, eventually if I get stopped out, I may get stopped out at a profit. I may get stopped out at a lot less than 8%. But the theory is to keep that loss at a maximum of 8% on any one stock.
And why that's important, you guys, as Jeff moves on to the next screen, why that's important to you is I want you to see, we're not trying to make you an expert on fundamentals or technical or economic analysis, but what I want you to see is there is a real strategy, and there is a strategy for managing and reducing your risk. So it's not based on hope. It's not based on, hey, let's buy and hold. It's based on a number of key data points that go back well over 100 years that are tried and true and proven to help protect your dollars and give you, as Jeff says it best, to put the math in your favor. So just summarizing that, Jeff, but go ahead through the building of the portfolios.
Yeah, so that's the primary thing, and you know, and again, the portfolio can go to 100% cash, what doesn't happen very often, but you know, luckily enough, it did happen at the end of February. Both portfolios, between hitting the upper price objectives and a few stocks getting stopped out, you know, allowed us to go to 100% cash. So these portfolios are not designed to be 100% invested 100% of the time. It's all about risk, how much risk is in the market, how much risk is in these individual securities themselves. So, you know, the example that's on the screen is one that everybody's familiar with, because at one time, before Apple and Amazon and these big technology companies took over as the largest companies in the world, ExxonMobil was the largest company in the world. And this chart doesn't go back very far. It goes back to the late 2019. But you can see there, so I'm looking at two screens, so I'm sorry, not looking right at you, where that mouse is moving, it broke the trend line. And then we started getting the COVID-19, you know, starting to hit, and the economy totally coming to an abrupt start, and a 35% decline from top to bottom in our markets. And as you can see, Exxon broke that trend line, and it went from the mid 70s all the way down to almost $30 a share in just a matter of a couple of months. And again, speaking about keeping the math in your favor, the markets dropped 35% again from top to bottom. That doesn't mean that now the markets have to go up 35% to get back to even. You know, again, the market, you know, if you were just in index funds and just to buy and hold, you had the math working against you in that, because now the markets have to go up. I think it's about 55% just to get back to even from that quick, you know, probably one of the most harsh and fastest downturns that our markets have ever seen. But even during these bad times, you know, here's some good examples of what happened to companies during COVID-19. You know, as we all know, you know, we're not out there shopping in the local boutiques and you know, doing all this shopping like we were just 6-8 weeks ago. We're all, you know, need something, we get on our phones, you know, and boom, we're ordering something. We're sitting at our house on our laptops, and we're ordering all these things that we would have before went out and bought. You know, not saying Amazon wasn't doing a great job before then, but we really depended on them now. And as you see, you know, Amazon pulled down, but they got near that trend line, and it was just like you know, was supposed to happen. They bounced off of that trend line, and Amazon during this started breaking new highs during this COVID-19 pandemic that we've had. And here's one that was actually added to the equity income portfolio. You know, a couple of months ago, I would have never thought that Clorox, you know, would, as boring as it is, you know, the bleach and the disinfectant wipes, you know, who would have ever thought that this would be an exciting company again? But you know what? The chart shows you what's actually happening in the marketplace. You know, people are out there, they're buying more bleach. You know, you can't hardly find disinfectant and you know, the stuff that that we put on our hands and everything. You know, Clorox makes those type of products, and the chart shows it. The stock has been, you know, kind of crazy and erratic, but guess what? It pulled down to that trend line. It held that trend line. It bounced off. And if you notice, again, you watch my mouse, that trend line is going up. So from where we originally purchased Clorox, you know, our stop loss point was down here, but now our stop loss point is all the way up here. And if this chart was updated, you would have seen it, you know, even another leg up over the last couple of days, because they came out with their earnings report earlier in the week, earlier this week or late last week, and you know, the chart was showing you that, guess what, they're going to beat earnings expectations, and they did. So this, you know, has been passed down through many generations. A lot of great investors have used this whole process of winning by not losing. Bernard Baruch is somebody that I follow very closely that followed this type of portfolio theory of winning by not losing. He was a great American, a great statesman. He served under 3 or 4 different presidents during World War I, World War II. Was one of the founding fathers of putting together the United Nations, and actually came up with the term the Cold War of late 40s and early 50s. But an unbelievable investor, and a quote that he has that, you know, I just make sure I look at it almost every single day. And in trading and investing, it's not how much you make, but how much you don't lose. And that is, you know, you've got to protect that capital, and that's what we're doing in these portfolios. You know, we all want those great returns, but again, you know, another Bernard Baruch quote: the only people that pick the bottoms, the only people that pick the tops are liars. Don't worry about picking tops and bottoms. Make some money in the middle and be happy with it. And any other questions or comments or anything, Justin?
Yeah, Jeff.
A whole lot of information all at once.
No, it's a ton of information. And guys, here again, we can't make an expert out of you or us in 45 minutes, but the idea was to give you just a couple of glimpses into the strategy. And so I want to summarize just for a minute. So imagine again, 6,500 stocks that go through fundamental screening to help you reduce risks that are narrowed down to 250. So you got 6,500 going to 250. Then another level of risk management for you is that 250 goes through a technical analysis, which gives us anywhere from 0 to about 15 securities. So we've gone from 6,500 through rigorous screens and analysis down to around 15. From there, we go through an economic analysis. Is the economy in green light area, yellow light? Is it red light? Then from there, decisions are made based on those trend lines to make purchases in those securities. And now another level of protection is the stop loss order at 8% underneath wherever you bought it. So again, if you bought it at $10 a share, the stop loss is at $9.20. Maybe my math should be pretty close there. So it protects your downside and gives you 14 other opportunities to make money. So you have layer upon layer upon layer upon layer of risk management. What does that do for you? Jeff gave you a great example that by the end of February, the portfolios were almost 100% in cash this year because of following those rigorous risk management techniques. And there are a lot of people that would have liked to have been in that position. And that's why this message is so important. It goes all the way back to the late 1800s. And Jeff, I think you did a tremendous job of explaining, giving an idea of the process. So what I would say to you guys, if you've got questions, if you'd like to hear more and see more, get with the person that invited you to get on this call. Set up a Zoom meeting, set up a conference call, get something on the calendar to where you can ask those questions and see how a strategy in a program like this would work for you. Again, the whole idea, how do we win by not losing? In this market, I think we would all agree, things are very different, and managing our risk is of extreme importance. And I think you can see why everyone on our team was excited to add Jeff to our family here at Now and Associates and what he brings to the table. And again, Jeff, I just say thank you for joining us tonight. I want to say thank you to everyone out there. Again, get your questions, get with the person that invited you, and we look forward to talking again soon. Hope you all have a blessed and a great evening, and we are done exactly in 45 minutes. So, Jeff, we did our job. Thank you all. Have a great evening, okay?
Thank you, Justin. Good night, everybody.
Good night, everybody.
Good night.